This is not financial nor professional advice. This video is for entertainment only. Hey everybody, we are in such a strange market, and I want to give you some historical perspective. Now, I realize that history doesn't repeat itself, but like Mark Twain says, history doesn't repeat itself, but it tends to rhyme. And so we got a little bit of rhyming going on with a different accent. And this is so different to the point that I'm thinking about shorting things or doing short-term swing trading and maybe even day trading. And none of this is my nature. It's something that you can do for a short while. I don't think it's for the average investor. It takes a little more skill and perseverance and willingness to take some losses. And you can lose significantly if you're wrong.
You've no idea the physical toll that 3 vasectomies have on a person.
But I plan to play this fairly safely and follow the data. And I think we have some trends that are coming to life now that are going to favor shorting for a short while. And I'm thinking of this as a short-term thing, and it has to be watched daily and all the time, which most people cannot do. When I started investing in the 1980s, people generally put their money in mutual funds. And the reason that works is because if you're busy and working and going to school and all that, or have family, you don't have the time to sit and watch every index every minute of the day, which is literally what I do now. Not every minute, but a lot of minutes. And you can't do that if you have family or education or you're working. You do it with mutual funds because they do the churning for you. They turn over their portfolios on average about 300% of the year. Meanwhile, they tell you to buy and hold because eventually they're going to come through. And this worked especially well in the 80s. I mean, it was really kind of highlighted in the 80s. That's mostly what people did. Peter Lynch, Fidelity Magellan, that's how he got famous. He had one of the largest mutual funds, and he did very well in it. Eventually, I transitioned from Fidelity Magellan, to Fidelity Contra Fund because it sort of agreed with my thinking in that I noticed that the market tends to do the opposite of what you think it'll do. And that's sort of what they tried to do, which made it so that more of the time they were buying low and selling high. And on average, I think they made 14% of the year, 14% per year. And if you can do that and not have to pay any attention to it, hallelujah, you know. And the 1987 crash was a quick crash. Okay, it went down 25% very quickly, but then it wasn't a long drawn out crash. And it recovered within 2 years. Within 2 years, if you stayed in the same mutual fund, you were back where you started, and then it started to go forward again. And it went forward in a major way during the 1980s. That was, and in the later 1990s, especially in the later 1990s, it went forward. So you have this choice of letting someone else manage your money mostly, or doing it yourself. And most people, I think, do some combination of the two. I don't think I did shorting until I started to see, hey, there's these major crashes. And that came about in the early 2000s, the dot-com crash, which was the worst crash. You know, man, we could see the potential of the internet. And it has changed everything. The only problem is it took 20 years to do it. Okay, that you can be too early with these things. It reminds me of solar energy. In the 1980s, I wanted to invest in solar energy, but no matter what I did, nothing ever took off because the technology wasn't there. And so you have to make sure that your technology is in line with the investing atmosphere. And it took until the late 1990s. It started, the hopes began for the internet, and then it continued until, through the 2010s, until we approached the 2010s. And then, oh my God, we had the 2008 Great Recession. And that was mainly caused, I think, by real estate. I had bankers telling me a year before it happened that it was going to happen. Okay? And the reason they knew this is they knew companies and investment firms that were creating these derivative investments where people could buy these derivative investments based on real estate that basically were not good, because they were loans on real estate that were not good loans, that the people really didn't have the money to back up the loans. And so they were eventually going to default. But they put these together in funds and put like hundreds of them into a fund, figuring that the group as a whole eventually would do okay, which of course it didn't. And it crashed the stock market and the real estate market. And, I think before the 2008 crash, the market stood at about 12,000 or thereabouts, or at least that's what I was at. And then it went down to 10,000, and I remembered what these bankers were telling me, and so I sold. Okay. And it proceeded to continue downward to 6,000. So that market crash literally lasted a long time, lost 50%, also crashed the real estate market, or vice versa, probably both. So these cataclysmic events can occur. And nowadays, I not only get out of the market, but I short it for short-term bases when it seems like it's not that much of a risk for me. It might be a bigger risk for some other people, but it's not that big of a risk for me because I'm used to doing this. So the market we see today, we see people saying buy the dip, okay? And I should also mention, I don't even count the 2020 crash, just because everybody could see that coming. When I heard about the flu and what it was bringing, and the experts telling you what was going to happen, you just got out of the market, And when it started to take off again, I listened to people like Cathie Wood, and she was right, because the technology had finally developed to a point where it could be deployed and be deployed in force. Okay. And so you had this massive swing, and especially like Tesla in 2018 and 2019 was like a dream. Okay. But the dream got carried away too much in early 2021. And we've kind of been trying to return to those days, but the Fed will not let the market crash, or at least that's what we were assured during 2020. And so you could invest in anything that was reasonable, and it was going up. Okay. That was a reasonable thing to happen. But in 2021, all of a sudden, towards the end of 2021, they're starting to talk about, well, we might increase rates. And then in 2022, they're guaranteeing you they're going to stop tapering, which tends to send interest rates higher. And then they're going to probably raise interest rates. And I think they've set the scene so much that I think it's pretty much priced in that interest rates are going to increase by March, starting in March, and maybe keep increasing. Now, I think Jerome Powell is naturally more of a bull than he is a bear. And I think I think he's being forced to do this by the politicians. The politicians are worried about inflation increasing, and they want to put the hold on inflation because they know everything has been done to increase it. There's never been this much federal money blasted into the monetary system. And so they have that going on. But they've blasted so much into the system that now they've got to sort of sweep it up. And they do that by stopping the tapering. And now they're going to raise interest rates, which is the most direct way of doing it. And I expect them to increase it by 0.25% each month, starting in March. And if they don't do it in March, it surely will start in April. But when they start it, I think it's going to be 0.25% per month for a while. Okay. And the only thing that'll dissuade them from doing this is if the market starts really going down badly. As long as they can get away with the market coming down a little bit, but not crashing, I think that's what they're going to do. And I have some investments I'm thinking of. The conservative way of doing it is I think the banks, insurance companies, and railroads are going to do okay, if not above average. So things like Berkshire Hathaway, Louisiana Pacific, Union Pacific probably, Bank of America, maybe Goldman Sachs, things like that I think are going to do well. And these are things you can hold on a long-term basis. At least you won't lose that much money, and you might make a little bit of money. The more direct way to counteract the increasing interest rates would be to do inverse funds. Now, inverse funds, or contra funds as they're sometimes called, they do the opposite of what the market says. So when you buy a share of these, for every dollar you put into these inverse or contra funds, for every dollar that the index they're following goes up, or for every dollar that the index they're following goes down, these go up. They do the opposite. And I'm expecting some major indexes to go down, so these will go up. And not only will they go up, they'll go up 300%. They'll go up 3 times whatever the selected index goes down. And the ones I'd like to do are the Direction, Direxion. They have a lot of inverse funds. The one I'm most familiar with is the SQQQ. Okay, they're shorting the top 100 stocks on a weighted basis in the NASDAQ, and they're doing the inverse of how those 100 largest stocks in the NASDAQ do. So these are the FANGs. It's Apple. It's Google, of course. It's Netflix. It's Microsoft. It's all the usual suspects. You know, these gigantic companies that make up the first 2 companies make up 50%. They make up 20% of the QQQs, and that's Apple and Microsoft. Okay. So these huge companies have been holding the markets up. They've been holding the indexes up. And I think they've got to come down. And I think we're actually doing the market a favor shorting these. They need to come down before the rest of the market can go forward. In fact, I think the market's going to at least the short-term stocks will keep going down until these large ones starts coming down. But on the other hand, there's another way of looking at it. If these start coming down, everything's coming down. If the large stocks start coming down, the small stocks are going to be coming down too. So I want to give you some indexes that I'll be using. and I watch these like a hawk. I watch them daily. I can watch them all the time. If you can do that and you have some experience doing this, maybe it's something you want to think about. But especially if you're just starting out, you want to do it in a small way. And I don't recommend this for anybody. I'm just describing what I'm doing. I can't recommend it simply because it's so risky. I'm used to how some stocks move. I'm particularly used to how Tesla moves. What I found is with Tesla, it starts to go up. It's going to keep going up. And if it starts to go down, it keeps going down. And so what am I going to do with Tesla? Well, ask me that particular day what it tends to be doing, because it tends to jump 100 or 200 points at a time in both directions. So that's sort of the way I play Tesla. But with these inverse stocks, again, I'm most familiar with the SQQQ, which triple leverages the NASDAQ largest 100 companies. And they kind of have been quiet, and the SQQ hasn't been doing the SQQQ. I might miss a Q there, but there's always 3 Qs when I say that, okay? I might jump into that more full force than I have been, simply because it's been kind of going up a little bit, but it just recently started to jump. And it jumped 7 percentage points in one day. Okay, I think that's a sign that the crash is coming. The inverse funds that focused on short stocks, I'm a little bit more hesitant to short those simply because they've had so much pain. So that's on the one side. On the other side, I've noticed that when the big stocks come down, everything's coming down, including the small stocks. And you could say there's momentum in the small stocks crashing. They're crashing, and they're probably going to keep crashing if this is as bad as I think it might be. And so the funds I think about with that, the Direction small cap bear fund, and that symbol is TZA, T zebra A, TZA. That's a triple leverage fund on the small cap index, and you're going to make triple the money if you for every dollar that you put in. Now, you want to remember, these are dangerous, because if they go down 34%, you lose all your money too. Okay, if it goes up 34%, you more than doubled your money. But if it goes down 34%, you've lost all your money too. So you want to remember that. The one that the screens, I run screens on the stocks, and the one that they favor is what I like to call shorty, and I just like to call it that. It really should be called sorty, because it's SRTY, SRTY, and this particular inverse fund does the inverse of the Russell 2000. So you're getting more of the small stocks in there, and it's triple leveraged. And I think with this one, you've especially got momentum going on. Again, I don't feel great about it, and I'm preferring to do the SQQQs because basically those large stocks need to come down. The small stocks, they're probably going to come down too, but I just am more conflicted about it. One short fund that's been doing really well, and it's been doing it's been doing much better than I want it to do, actually, is Labda, and that's LABD. And that shorts the biotechnology index, and it's a triple leverage inverse fund. And that thing's been going up gangbusters in the last week or so. So that would be another one to consider. Its symbol is LABD. Again, I have a hard time shorting biotechnology because I think it saved my life. I used to have MS, and now I show virtually no symbols. You know, you see this? I couldn't think about doing such a thing back then, and I talked funnier than I do now, and it's a miracle, and I can't short miracles, and that's what biotechnology is. I think I'm gonna cry. I I better quit this film. Uh, Good luck in all your investing. Be sure to like and subscribe if this resonates with you, and tell me what you think, and give me some context to your investing. I like hearing what other people are doing, what they think is right or wrong about what I'm doing. I do have a conscience. I think the SQQ, yes, QQQ, is going to do the least harm, and actually will do some good. Because remember, when I short a fund like that, I'm also promising to buy it in the future. Okay, and I'm going to be shorting it as it's starting to go back up. Okay, so I'm promising to buy that stock back. The fund does it for me. I avoid the hassle. Thank them very much. But I think it's a good way to play this uncertain and swinging market, which it surely is. Thanks a lot. Be sure to like and subscribe so that you receive future videos. Good luck with your investing, and I will see you in the future.